Hello, this is Corner Invest. So is it now time for the stock market to reverse back to all-time highs again? So in today's video, we'll be covering a few things. We'll be covering the key earnings next week, the stock market reversal, as well as some questions that you guys have left me on certain stocks. So this is the earnings from next week. On Tuesday, we have massive earnings from Spotify as well as Visa. On Wednesday, we have two Max 7, so Microsoft as well as Meta. On Thursday, we have the big one as well, which is from Amazon as well as Apple over here. So next week is a packed week. We have most of the S&P 500 reporting next week as well. So let's talk about the first stock in the earnings season over here, which is Spotify. So Spotify is a company that is up 35% year to date already, and it is currently trading at a 99 times earnings. So for Spotify over here, the story is simple. It's just subscriber growth. Ever since 2015 or so, subscriber growth has gone up and up and up non-stop. And this is a company that is seeing accelerated growth because more people are hopping onto Spotify. There isn't much competition in this space. So Spotify over here, this is their free cash flow metric. So free cash flow has exploded ever since 2022 or so. So in 2022, everyone was doubting this company. Everyone was pricing in the fact that they cannot turn profitable. But as soon as they turn profitable, the stock just skyrocketed. It's up around 300% since 2022, I believe. And it is one of the best performing stocks in your Nasdaq today. So this is the problems that I have with Spotify. So Spotify is a low margin business. Most of the money will go to the actual music label itself. So for example, let's say if you're to compare Spotify's net profit margin as compared to a company like, let's say, Netflix, Netflix provides a subscription business model as well. So they screen all the different movies and all the different shows that they have. And for Spotify over here, they do a similar thing. They provide music to all your different users over here. But for Spotify, the net profit margin is extremely low. So net profit margin is around 7% only, because most of the money that they get, they have to give it back to the artists, they have to give it back to the music labels and all that, because they don't own the music itself. So all your music labels, like for example, Universal Music Group, they own the music, they own the rights to the music, and so they'll have a large royalty being given out from Spotify itself. So for Spotify over here, another problem with the business is simply just the high valuation. So this stock over here has skyrocketed and it is now trading at around 104 times earnings. That's just incredible. That is almost Palantir type valuation already. And so yes, although this company is very fast growing, it's still growing very quickly, maybe 40-50% or so. But for 100 times earnings, I think it is hard to justify at this current stage. Next stock is Microsoft. So Microsoft over here is a company that is down around 6% year to date. It hit its 52-week low around 2 weeks ago, and currently now is trading at around a 31 times earnings. So for Microsoft here, let's talk about the CapEx. So Google, they reaffirmed their CapEx guidance in their latest quarter. So this is Google. So they've said that they'll be spending 75 billion in CapEx in 2025, with the bulk going to servers and data centers to support growth across Google services, cloud, and DeepMind. This is above the street's estimate of 72 billion, a positive sign for the AI infrastructure investment. So to keep this AI story strong, Microsoft will have to reaffirm their capex as well. So you don't want Satya to come out and say that the capex is going to come down because of the tariffs and because the profitability is going to slow down. You want Satya to come out and say that the capex is still strong, because all these capex investments, you want to see returns on it. And the only way for them to see returns on it is to continually invest on it, so that the infrastructure can have enough capacity to fulfill all the demands that they have. So this is the main metric that everyone will be looking out for when it comes to Microsoft's earnings. It will be the Azure growth. So Azure growth has been picking up lately as well. Since around Q2 of 2023, it's been going up almost every single quarter, and I do expect them to have around 20+% growth as well. And if they fail to meet that demand, then of course the stock is going to drop. So Google, they posted earnings. They had around a 28% revenue growth for their GCP business. Amazon AWS had around 19% growth in Q4 as well. So I do believe and I do hope that Azure can post such numbers as well. So let's see where this one goes in terms of its AI story. So the next one is Meta. So Meta is one of the cheapest Max 7 stocks out there. It is almost on par with Google in terms of valuation. So at one point, this stock went up around all the way up to $740. It went up for almost 20 days straight, and then it went down around 30% all the way until $480 or so, and now it has rebounded back up to around $550. So the stock now is currently trading at a 22 times earnings. It is not too demanding for a Max 7 stock that is high quality. So let's see where this earnings will bring us. So for Meta today, it is arguably doing better than Google in terms of the ad market, but they are concentrated in ads. So if you're to compare, let's say, Google's business model as compared to Meta, Google is more diversified. They have all the other business model as well, including the cloud, Waymo, YouTube, and all that. Whereas for Meta, it is almost 100% into ads. So if there's some form of downturn in the ad market, especially since the ad market is extremely cyclical, then you will likely see a downturn in Meta's earnings as well. So this is Meta's ad impression over the years. It's been coming down, but it is still positive as compared to Google. Google Network posted around a negative 5% year-on-year ad impression, which consists of your YouTube as well as your AdMob. So it's still positive for Meta to have a positive ad impressions. And for Meta over here, it has extreme pricing power. So if you have to look at the average price per ad worldwide, it has increased 14% in the last quarter. And if they can continue with this pricing power and continue increasing the prices of the ads, then you will likely see a bit in terms of their revenue over here. So this is Meta's EPS explosion. So in 2024, the EPS went up by around 60% or so year on year. That's just incredible. And the streets are expecting around 10% EPS growth this year. So if Meta can continue with this explosive growth, I do believe that Meta is one of the stocks that you can own in the stock market today. But for me, it's quite concentrated in the ad market. That's why I only have a very small position in it. Next stock is Amazon. Amazon is one of the highest quality businesses out there. It is one that I think will stay for the next 10 years, next 15 years or so. So Amazon is currently trading at around a 34 times earnings. It's rebounded from its 52-week low already. At one point, it was trading at around $160. Now it is trading close to $190. So that's around a 15% bounce from its lows. Although there's been a bounce so far, it is still around 15% down year to date and around 20% or 30% down from its all-time highs. So this is Amazon's story over here. The main story is just the AWS story. So whether or not they can keep up with growth in terms of AWS, because AWS makes up around 67% of Amazon's entire net income. And if AWS slows down, then you will likely see Amazon's earnings being hit as well. So next portion, I'll be talking about Amazon and tariffs as well. So Amazon in 2019, when the tariffs between the US and China came into effect, Amazon's cost of sales actually went up by around, I believe, 18% or so, 19% or so. So Amazon's cost of sale went up by around 19%. And yeah, overall, I think the impacts won't be as large as everyone thinks it will be, because if you have to look back at 2019, the US imposed around 25% tariffs on China, and the cost of sales actually went down in terms of the net sales as a percentage as well. So let's see what the management has to say about the tariffs. The tariff impact hasn't come in yet. It will take Q2, Q3 for the tariff impacts to come in. So let's see how this one goes for Amazon. So for Amazon's story right now, it is simple. It is just a valuation story as well as a margin expansion. So this is Amazon's net margin over time. And as you can see, there's been an explosion in terms of the net margin because AWS is increasing its operating margin, and you have all your other businesses as well, including your subscription business, your advertising business, your third-party seller businesses. All of them are increasing margins together. You don't need the retail side for Amazon's earnings to explode. And all you need is just Amazon to reach up to levels of Google, Meta in terms of the advertising, and you could easily see this stock going up 20-30% or so in terms of its earnings already. So for Amazon over here, it is trading at a very reasonable valuation. So the price to operating cash flow now is around a 17 times, and the median in the past 10-20 years or so is around a 20.1 times. So you can clearly see that historically Amazon is undervalued. But of course, this company is experiencing much lesser growth now as compared to back then. Back then, the valuation was a lot more bizarre and explosive because the company had extreme growth. It could grow 100%, 200% year on year and so on. But currently, we're seeing around 80% growth or so. But I still think that Amazon can easily reach around a 15 to 20% EPS growth year on year, which is what I want to see for my businesses. And trading at around a 33 times earnings today is more than reasonable for this business. Next one is Apple. So Apple is the last Mag 7 to report on Thursday. Apple today is currently trading at a 33 times earnings, and year to date it is now around 15%. So it is a stock that has been hit as well, although it is one of the juggernauts in the stock market. It's one of the most well-loved ones out there. So for Apple over here, the problem with the business is the revenue growth is stagnating. So over here, since 2022 or so, revenue has been almost flat. And that's why Warren Buffett has been selling out of the business. So Apple today, for me, it's a sell simply because they lack innovation. They don't have any growth drivers for the businesses other than the Apple services portion, which is growing quite substantially. The portion where they sell their phones, their MacBook, their iPads and all that, those are stagnating already because there's not much innovation that they can do on top of what they already have made. And for me, Apple is a stock that I would sell if I were to own this company. But it is a stable one that will likely just continue on and on over the next few years. But for its valuation today at around 33 times, I think it is quite demanding for this stock. So next portion, I'll be talking about the stock market reversal. So this is the bearish trend over the past few months or so. So this is the AAI bears above 50% in terms of the sentiments. And as you can see, we have hit around 9 weeks already. So this is a historical high in terms of the past 20 years or so. And we have never hit this point in terms of its history itself. So you can clearly see that the bearish trend was building up over the past few months or so as Trump was continually imposing his tariffs on China and all the other countries as well. So this is the Zweig Breath Trust. I'm sure you guys have seen this on Twitter. So everyone has been talking about how this Zweig Breath Trust has been activated. So over here, if you have to look back at history, so 6 months later, there was never a point in history where the Zweig Breath Trust was negative in terms of the stock market returns, and on average it has returned around a 16% in 6 months or so. So this could be the start of a new bull market. No one knows. Let's see how this one goes, but be cautious because the Nasdaq has been up more than 1% for 4 straight days already. So over here, as you can see, the 1-day return, 2-day return, 3-day return are almost all negative in most instances, and in fact the 2 weeks later return is also negative as well, with an average of around -2%. So please be wary of the reversal that we're having so far. This market could pull back, no one knows. Let's see how this one goes. And in fact, for all these different trends over here, remember the sun rule back in the day when everyone was talking about how the sun rule was triggered and how the sun rule could never work? This could be the same instance as well, where something triggers and then it untriggers again. So all these things, they come and go. It is better for you to buy when valuations make sense instead of trying to time the bottom. So the tariff impacts haven't come into play yet. No one knows how extensive all these tariffs will hurt businesses. The tariff impacts will come in Q3, Q4 or so, and that is where you see earnings revisions, earnings dropping and all that. And that is usually when the stock market starts to collapse as well. Last portion, I'll be talking about some of the questions that you guys have asked on some certain stocks. So let's start off with this one over here. What do you think about Airbus? I see it as being a duopoly with Boeing, like MasterCard and Visa. So for Airbus over here, I'm not quite sure what their business model is. I do believe that they make some form of helicopters and airplanes and all that, similar to what Boeing does. For Boeing, it is a company that has a lot of market share, but the problem with Boeing is the brand name itself as well as the actual fundamentals. So it is not making money, although it is in a strong position in your aircraft and all your different airplane building machines and all that. But for Airbus over here, I've looked at the fundamentals. The fundamentals are not too bad, but I think the business and the industry itself is too capital intensive. So normally for my stocks, what I want to own is companies that are extremely capital light. So ASML is an exception because it is operating in a monopoly. But generally for all the stocks that I own, I want them to be capital light. Because capital light means all these businesses can continue operating for the next 10, 20 years or so without any hindrance and all that. So for me, Airbus, Boeing, I think they are avoids simply because the business is too capital intensive and there isn't a strong fundamentals backing up all these two stocks over here. Next one. So what are your views on Robinhood? So for me, I think Robinhood, the problem with the business is Robinhood is too reliant on the bull market. So when there's a bull market, you'll see a lot of different retail stocks, a lot of retail investors coming in and gambling on Robinhood, and that is when you see the earnings of Robinhood basically being inflated and so on. But when the bear market comes in, like what we've seen over the past 2 months or so, it's not even a bear market yet. Robinhood dropped from around $60 to around $29, and that is just the stock price itself. We don't know what is going to happen in terms of its earnings. So I don't like Robinhood because it is too gamble-like. It is creating sort of like a casino impression of the stock market, which is what I don't like people to have. I want people to have the impression that the stock market is where people make money, not where people gamble. And for me, I think the best brokerage out there is IBKR. IBKR is where you see less retail investors coming in to gamble because IBKR, the interface is a lot more professional. It is where all the different quality investors, they start their portfolios on in there. My favorite brokerage, of course, is IBKR. I would like to own IBKR stock one day, hopefully soon. But for Robinhood over here, I think the valuation, it is just trading on inflated earnings. And that is what I don't like to see for my stocks. Of course, in a bull market, Robinhood will outperform. But in a bear market, in a downside market, then you will see Robinhood dropping 30% in terms of its earnings. And then stock could easily drop another 50%. And that is what I don't like to have in my portfolio. Last one, thoughts on Adobe, thinking of buying in right now. So for Adobe, it's actually one of the businesses that I've considered over the past 6 months, past 1 year or so, because the valuation has been quite compelling over this time. So currently Adobe is trading at around 22 times. But for me, I think Adobe is a business that is facing a lot of threat. So I myself, I use Adobe almost every single day for my staff. But for Adobe, there is creation of images through your AI, there's creation through Llama, through your ChatGPT, Grok, and all that. And I think that all these different LLMs and all this different image generation, they will just exponentially grow over time. And that is where you will see Adobe's market share being eaten. There are other alternatives out there as well, including Canva, Figma. Canva hasn't gone IPO yet. Figma is about to go IPO. And yeah, you could see a lot of competition in this space from all these different businesses over here. And I calculated Adobe's numbers. So Adobe, the revenue growth has been around 10% from the past few years or so. And from what I've gathered, the revenue growth has been solely driven by price increases. So there hasn't been much volume change for this business. And over time, if a business relies solely on just price increases, that is a business that is basically slowing down and picking out already, and then it will start to come down once the product that they sell is so expensive that no one else can afford it. And so for me, I think Adobe is a company that is trading at a very good valuation right now, around 22 times earnings. But I constantly see myself comparing Adobe to Google, and I do believe that Google is a much higher quality business that is facing much less threat as compared to Adobe itself. So for me, I think Adobe is an avoid. I value predictability more than the valuation of the stock, and that's why I haven't invested in Adobe, although I'm a user of their products almost every single day. Hope you guys have found this one useful, and invest safe this week in this earnings week.